All that glisters is not gold. Often have you heard that told. We all know these famous lines from Shakespeare's Merchant of Venice. Good morning, ladies and gentlemen. Welcome to our exciting and informative webinar on gold exchange traded funds or gold ETFs. This episode is brought to you as part of the Investor Education and Awareness Initiative by the ICICI Prudential Asset Management Company. I am Meghna Maiti, Assistant Editor of Outlook Money and your host for this session. And today we have an exciting topic to discuss, gold ETFs. Gold serves as a solid investment due to its historical stability, acting as a hedge against inflation and economic uncertainties. Its limited supply and universal value bolster its appeal. Gold's ability to diversify portfolios, offering a safe haven during market downturns, attracts investors seeking wealth preservation. Moreover, it's easily accessible through various avenues like digital gold, sovereign gold bonds, and gold ETFs, making it a flexible and convenient asset to include in investment strategies. To guide us through this session today, we have with us Mr. Chintan Haria from ICICI Pru MF and Mr. Mohit from MoneyFront. Let me give a brief introduction of Mr. Chintan Haria. He has over 15 years of experience in the field of fund management and strategy and portfolio management. At present, he is the principal investment strategy of ICICI Prudential Asset Management Company. Chintan joined IPAMC in 2005. Thanks for joining in, Mr. Chintan Haria. And we have with us Mr. Mohit Gang. He is an investment professional with over 15 years of experience in product, strategy, and managing UHNI portfolios across a myriad of investment tools like mutual funds, stocks, bonds, alternate assets, etc. Since 2016, he is the co-founder and CEO of MoneyFront, a robo-advisory platform. A very good welcome, Mr. Mohit Gang.
Thank you so much.
Now, moving on to our discussion with our speakers. First, Chintan, if you could please explain our viewers what are gold ETFs and how do they work?
Thank you. So I think in the last 10, maybe 5 to 10 years, we are seeing financial investments in India improve meaningfully as more and more investors get aware of what are the options. Within that, mutual funds have been one of the bigger catalysts to provide access to financial investments, be it equity, debt, and commodities. While equity mutual funds and debt mutual funds are quite popular, we are seeing in the last many years, even gold and recently silver ETFs becoming popular. What are ETFs in general? ETFs are exchange traded funds. These are mutual funds which are traded on the exchange. So much like how you buy and sell a single share or equity on the exchange, you can buy mutual funds. Within that, you have equity ETFs, you have debt ETFs, and then you have gold and silver ETFs in India. Gold ETFs, of course, are there since last more than 15 years and very popular among investors for investing in gold, especially as part of their financial asset allocation. As you rightly mentioned, there are many avenues for investments, be it sovereign gold bonds, gold ETFs, and digital gold, and of course, physical gold, be it in the form of jewelry, bars, or coins. Different benefits each of these provide. But I think for those who are looking at asset allocation, gold ETFs provide a good, easy way of investing and divesting in the financial form. What are gold ETFs? Gold ETFs are essentially on exchange. You can buy and sell units which are of gold ETF. And as a backing, when you're buying the gold ETF, you're getting units which are backed by physical gold. The physical gold it's the responsibility of the asset management company managing the gold ETF to ensure that the physical gold is in LBMA approved vaults. It's LBMA approved gold in vaults which are approved and secure. So from a security, from a purity perspective, investors don't have to worry. We are taking the onus of ensuring that for every unit that you buy on the exchange, there is a backing of physical gold against that unit. And that essentially is how gold ETFs work. As far as pricing of the gold ETFs are concerned, it is essentially international prices converted into domestic rupee terms. So what you see on the exchange is more or less a reflection of the live prices of gold, which exist in the Indian markets. And so from your investment standpoint, you're getting the benefit of gold prices through the gold ETF while not having to bother about the purity or the physical security of managing physical gold. And one last thing on gold, the ETFs, they are typically one unit would be in the range of say 50 to 100 rupees. So with lower amounts also, you can start accumulating for your long-term allocation to gold. So you don't necessarily need to have a lot of money. So this is in a nutshell about gold ETFs. Thank you.
Thank you. Moving on to Mohit, there are gold ETFs and there are gold mutual funds. So how do they differ?
Okay, so look, as Chintan bhai rightly said, explained beautifully the way ETFs are constructed and what is an ETF. A gold fund is nothing but it is a fund based on underlying as an ETF, right? So finally, gold fund is a derivative of the ETF itself. It is launched by a mutual fund without a demat form. An ETF is more in a dematerialized form, which means if you want to buy it on the exchange, if you buy units of gold on an exchange, then you go through the ETF route, which is what you can do, buy and sell on the exchange itself. But when you buy through a fund house, it comes to you in a folio form or a non-dematted form. That is what a gold fund is all about. Otherwise, all the other material characteristics remain as it is, the way Chintan bhai explained, which is that it is backed by physical gold. The difference is that when you buy gold in a fund form, you buy and sell at the day ends NAV. ETF, you can buy in the intraday prices also on the exchange. So that's a difference. Otherwise, in terms of taxation, it remains same. It is again launched by fund houses because there are many investors who don't hold a demat account or who don't want to go through the hassles of having a broking account and then buying and selling on the exchanges. So they prefer buying and selling on the through the mutual fund house. Out here, the liquidity is provided by the fund house itself. So that also is not a area of concern. So it depends on the choice of an individual investor. What format does he prefer? But buying an ETF or buying a gold fund are more or less alike. It is just about what is more convenient to you and what do you find easy as an investor.
Right. Chintan, if you could please explain, while investing in physical gold has its limitations, there are other ways to invest in gold, like digital gold, sovereign gold bonds. So how does gold ETF compare to these options and what are its unique advantages?
So from a comparison standpoint, if I look at sovereign gold bonds, which are issued by RBI, clearly they have a taxation advantage because after 8 years, they are tax-free and they give you 2.5% taxable every year. So sovereign gold bonds become a unique long-term way of investing in gold. The only challenge there you will find is probably the liquidity is not strong. So if you want to participate in the gold markets with liquidity, gold ETFs become a good choice for you. They are transparent in terms of how they are managed. Like I had mentioned, there is actual physical gold behind it, LBMA approved, thoroughly checked, verified, audited, and managed by the asset management company or the mutual fund. And if you look at from a comparative standpoint, if you want to trade in and trade out, gold ETFs make it that much easier. There is less impact cost. And of course, you don't have to worry about the purity of it. So comparative with sovereign gold bonds, while there is a disadvantage of taxation to gold ETFs, because after the changes that happened in taxation in March, gold ETFs have lost the indexation benefit for now at least. But from a trading point of view and from an allocation point of view, if you're looking to get in and get out of gold ETFs as an allocation, they make it liquid. Also, in sovereign gold bonds, there are limitations as far as how much an individual can invest. The limit is quite high, but there are limitations. While in gold ETFs, there are no limits on how much you can invest. So if some large investor wants to invest a very large sum, then gold ETF is a good route to go by. Compared to digital gold, I'm not sure too much about digital gold, how well it is regulated. So investors have to be careful of that. But compared to digital gold, I would say gold ETFs would hold probably a little better edge and in terms of transparency and what you get. compared to physical gold. Physical gold gives you the advantage of indexation. So taxation-wise, physical gold is better, but then the purity and the impact cost plus the size and scale at which you need to probably trade and the pricing that you will get when you actually want to trade may not be as transparent as in the case of gold ETF. So I think each one, like I said, has its use cases, but currently the disadvantage of taxation in gold ETFs exists, but the advantage of liquidity being very strong, and there is no limitation of how much you can invest in gold ETFs. So for larger portfolios, the allocation ease is always there. Plus, like I said, you can buy as low as 1 unit. So for those who do not have a very large corpus, for them, having to allocate even 1 unit of gold, which will be 50 to 100 rupees, can make it worthy in terms of having an allocation to gold ETF. So these are the advantages of gold ETF vis-a-vis other investment avenues that are available to invest in gold.
Right. If you could also, Chintan, if you could also share your thoughts on how gold ETFs can act as a hedge against inflation and economic uncertainties.
So I think gold as an asset class has remained a store of value for the last thousands of years. If I look at ancient Indian civilization as well, for centuries and probably thousands of years, it has been a norm to uh, have gold as a security from your family perspective. And if you look at the main reason why is that when inflation, which is essentially the prices of goods and services, go up, especially in uncertain environments, it could be due to war or economic uncertainty, people tend to move towards gold as a safe haven investment asset. So you tend to move towards gold when there is economic uncertainty or geopolitical uncertainty. Now, both exist today. Geopolitical uncertainty in terms of the two parallel wars which are going on right now, and economic uncertainty in terms of higher interest rates leading to global slowdown, specifically in Europe and US. And China has its own issues in terms of growth. So in this backdrop, gold, which historically, if you look at it, let's look at the last 50 years history to be just looking at history. 1970 to 1980, gold did exceedingly well when inflation was high. Then for 20 years between 1980 to 2000, gold actually gave no returns in dollar terms. And again, 2000 to 2010, gold gave very good returns because inflation was high in that decade. 2010 to 2020, there was no inflation, interest rates were low, global growth was low, gold did not give any returns. In fact, if you look at global gold prices, they've remained at $1,200 from 2011 to 2023. So for 12 years, returns in gold in dollar terms have been virtually zero. They did go down to $1,000 and have come up, but for 12 years, the gold returns have been zero at a time where inflation was not there. Now, with the problems of debt which exist in the world, the inflation probably going behind us in terms of the inflation numbers coming lower, we may see a global Federal Reserve or US Federal Reserve and global banks again print money to pump prime the economy, which would lead to inflation. And at that economic uncertain time, gold again probably is a good hedge, especially against inflation, and I would say bonds. So gold in the next 10 years when inflation may be higher than the previous 10 years, and at a time where gold for last 10 years has not given any return, becomes a good asset to invest in from a safe haven asset point of view, from an inflation hedge point of view, and also the theory of mean reversion may work well with gold. So I think for 10 years, investors have basically ignored gold because it has given no returns in the international markets. But I think gold's time has come, and in the next 3, 4, 5 years, that will well reflect in terms of the gold prices. And as we speak in India, of course, we are probably touching all-time highs in rupee terms because of the depreciation of the rupee and the import duty. Thank you.
Mohit, gold prices have remained strong amid speculation of US Federal Reserve policy easing. So how can we expect gold prices to pan out going ahead, especially in the first half of 2024?
Look, honestly, I think Chintan Bhai has given a very nice backdrop of the entire history of gold prices and everything. Just to add few pointers to it, uh, uh, we are going through a robust marriage cycle in the country right now. And just to give you some stats around it, between November 20th to December 20th, we will have 35 lakh weddings in India. The amount estimated to be spent on these weddings is around 4.53 lakh crores, out of which 10% will get spent on jewelry alone. and out of which 8% will go purely into gold purchasing or jewelry form, right? So that's the extent to what Indians will spend on gold just alone in this season, right? So the demand and the appetite for gold somehow doesn't seem to die in our country, right? And Indians are like the big hoarders of gold, whether it be in jewelry or physical form or any other form. The digital forms, the ETFs and everything are yet to catch up to a massive extent when it comes to gold, right? Uh, the other background to gold is the Indian price denominated gold. Look, I look at it from an Indian investor perspective, and from that perspective, if the rupee continues to depreciate, which for last 20 years it has depreciated to a tune of almost around 3.5% to 4% against the dollar, if rupee continues to show that trend, right, so you have that much amount logged as return for gold, plus the underlying value of gold or the underlying prices of gold, which are now shooting past $2,000, right? After a fairly long while, after a fairly long and a huge gestation period, gold is actually showing signs of shooting past the $2,000 mark, which, if you talk to any technical trader in the market, they will tell you is a very, very big drawing line. If gold continues to remain over $2,000 mark, it will show some signs of strength from here on, clubbed with geopolitical tensions, clubbed with a high inflation across the globe. And as you rightly said, gold is considered as an hedge against inflation. So if you have a 4% kind of an inflation scenario, plus a 3.5% rupee depreciation and some amount of actual appreciation in the prices of gold, I think we are set for a robust outlook on the gold from here on. To my mind, I think it's very difficult to call out whether first half of 2024 will be beneficial or not. But from an investor and an asset allocation strategy perspective, having 10% in these kind of commodities, which is gold and silver, and holding for next at least 3 to 5 years will be hugely rewarding from here on, because the world now is entering a phase of high uncertainty. There are a lot of geopolitical tensions which are simmering on the globe, and gold, look, honestly, gold is a real hedge against any kind of geopolitical event or any kind of tensions and inflation and other things, yes, kept aside, but gold is the real currency, right? So I think world is drawing back to its basics, and gold should be a critical part, and the outlook is fairly positive from here on.
Yes, Mohit, like you rightly mentioned, it's a common wisdom, and that, experts like you say that one should invest about 10% portfolio in gold. So just want to understand, should they invest in gold ETFs or spread it across other options of gold investment?
Look, to each investor, it's his own story, honestly. If you really think your outlook is shorter, basically, and you would want to trade in and capture intraday prices, or if the denominations are very small, as Chintan Bhai said, or if the values are very large, again, then I think ETFs or gold funds are the best choices available. But if you want a good taxation, and if you're okay with an 8-year holding horizon, then I think nothing can beat sovereign gold bonds. Look, you get 2.5% extra interest. You are linked to gold prices. It is backed by RBI, right? So there is no risk per se to your investment. It comes into your demat account. There is liquidity, not to a great extent like an ETF, but you can sell it on the exchange. However, your taxation then becomes inimical if you sell it prior to your maturity. But if you hold it to maturity, then you're having gold returns completely tax free, right? And your prices are linked to the gold underlying prices. So to my mind, I think SGB rates as the best form of investment. But if you have constraints, which means your holding period is not large, your ticket sizes are small, or your ticket sizes are fairly large, then again, I think ETF or a gold fund will merit allocation. But in nutshell, my whole point is, in whatever form you buy gold, I think gold has to be a critical part of everyone's portfolio.
So with this, we have come to the end of today's episode. Thank you, Chintan. Thank you, Mr. Mohit, for joining us today. Viewers, we hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at editor@outlookmoney.com. We'll be back with our next edition soon. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.